So you just talked about it a little bit earlier, the deferred sales tax trust. People are listening to that and they're like, well, what is that? How does it work? What does it entail? When do I use it?
Absolutely. So most high net worth individuals, or even those who've bought cryptocurrency at a low price, or a primary home, or a business, they struggle with capital gains tax when they go to sell, and it's somewhere between 30 and 50% of the gain, depending on the depreciation recapture and depending on what state they live in. So we use a deferred sales trust, which is just the tool, the strategy to give them tax deferral, liquidity, diversification, and the ability to eliminate the need for the 1031 exchange forever, all so they can create and preserve more wealth. So I'm going to give you a few stats, and then we're going to dive in right into what this strategy is. So this is the first step to really understand what's happening. We call this the perfect storm, and I think there's 3 storms going on right now. And we'll start with the one huge storm, which is the demographics. So according to the American Bankers Association, there's about 17 to 20 trillion dollars, Barry, that's going to transfer from one generation to the next in the next 20 years. Now, this is the baby boomers. Okay, so these are our parents, and our parents have accumulated, according to this study, the most amount of wealth in the history of the planet. Okay, and over the next 20 years, they're going to be what? Transferring that to their kids. Now, that same study found there's about 77 million baby boomers in the U.S. alone, and about 10,000 are turning 65 every day. So this next part of this perfect storm is, how do they transfer it without getting hammered by capital gains tax? And how do they sell and retire from a lot of this? What is this? High-end primary homes. We just helped a gentleman out of Palo Alto. He sold an $8 million primary home and he moved to Nevada, not Henderson, not too far from you, right? And his big thing was he wanted to downsize. He wanted to get in another state. He wanted to move closer to a place where he wanted to be in, right? So that was his transformation for him, right? The next thing is, it works for business owners, right? Business owners that are selling, a dental practice, and we're helping an oral surgeon in Los Angeles right now. We helped the gentleman who sold it out of Alabama, a business, a marketing business, and you can defer the tax and then move that into the next thing that you want to move into. So all of this is happening. That's the first part of the storm. They want to sell, they want to retire, they want to downsize, they want to move to closer to grandkids, they want to start the next business venture, but this 30 to 50% in capital gains tax is restricting them. And or what other strategies they have, such as the 1031 exchange, don't qualify. Like the 1031 does not work for a primary home, doesn't work for cryptocurrency, doesn't work for a business, right? It only works for investment property, which leads into the second storm. And this is the political storm we're facing right now. And the political storm, the Biden administration is proposing potentially to limit or eliminate the 1031 exchange, except for $500,000 of gain, which essentially eliminates the 1031 exchange for a huge number of people. So if you've owned a property, let's say for $1 million, and you're selling it for $5, you've owned it for 20 years, well, guess what? They'll give you $500,000 deferral, but that other amount, that additional amount of 3.5, would be taxed at capital gains tax or even ordinary income tax rates. So it's very, very challenging right now for people if should that pass. The second thing is inventory is so low, right? Inventory is so low, making values of properties skyrocket, which leads me back to the 05-06 days, right? We knew it wasn't a good time to buy. We knew it was a great time to sell, but it was a terrible time to 1031 and buy. And that's where people got hurt, right? They had too much debt, not enough liquidity, not enough diversification, and they knew they were overpaying. They were letting the tax tail wag the investment dog. And so with the Deferred Sales Trust, we can help them escape these challenges, okay, with the politics, with the perfect storm with baby boomers, and with the low inventory real estate market. Also, we'll add a couple of things on the politics side. They're also proposing to take away or eliminate the stepped-up basis, which is huge. They're also talking about doubling the capital gains tax rate from 20% on federal level up to about 40%. So you look at all of that and it's just like, oh my gosh, like you really have to defer. If you don't defer, potentially instead of 30 to 50%, like I said in the beginning, it could be 50 to 70%. That's how serious this is, which is kind of mind-numbing to even think about, right? So we come in with the Deferred Sales Trust and we defer this, right? So it's kind of like a 401k or an IRA. It's actually in a manufactured installment sale. It's known as a seller carryback. So Barry, I'll give you an example. If you were to sell a $10 million multifamily property in Vegas, let's imagine you own it free and clear. You've owned it for 27 and a half years. You're fully depreciated. And I say, hey, Barry, I want to buy that. And you say, sure. And I say, I got a buyer. His name's Joe. He wants to buy it, Barry. 10 million. Would you buy it from him? And you go, sure, I'll sell to Joe. Joe gives you all 10 million. You sell it. Well, that would trigger the tax, right? Let's just say 40% was the number. Well, you're going to pay 4 million of tax. You're going to net 6. Instead, you can do something called a seller carryback, where you, instead of taking all 10 million in one lump sum, you could take it over an installment over a period of time. And in the meantime, you're not paying tax on what you haven't received. So let's imagine Joe gave you a 0 down payment. You could carry back the note for 10 million. In that scenario, you haven't paid any tax because you haven't received anything yet. Now, on the interest payment, you'll pay ordinary income tax. So this is where we come in on the Deferred Sales Trust. We say, Barry, we don't want you to finance Joe completely because that's not going to give you a lot of diversification. You're going to have to count on him. The funds are going to be illiquid. You might have to foreclose. Let's insert the trust. Let's ask Joe to go get a loan for 10 million somewhere else, right? Or bring it all cash. And instead of financing Joe, you're going to finance the trust. And the trust is going to turn around and sell it to Joe, the ultimate buyer. When we do it in that order, what happens is you end up with a promissory note and you're in a deferral state, but you can invest it wherever you like. Where? Stocks, bonds, mutual funds, hard money lending, ground up development. You can start a new business venture. As long as it has economic purpose and substance and business purpose, you can keep it deferred. Okay, the IRS likes this because it actually spurs economic growth. It's the same reason we don't want them to get rid of the 1031 exchange, because we believe it actually gets them more tax revenue, more tax dollars, because you're incentivizing people to trade, let's say, a 50-unit apartment into 100 units and improve that. And that creates more jobs, more tax revenue, and better housing. Hopefully they stay there, but I'll pause there. I said a whole lot. Make sure that's making sense.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.